Chapter 8, Part 2, Inventory Valuations Using Periodic. Now, specific identification, we're going to use that when we can identify the cost to each item. This tends to go for high-end items like maybe luxury boats or jewelry, high-end jewelry. So again, they usually are unique in nature, and you have low sales volume, so it's easy to do this. And this makes it relatively easy and economically feasible to associate each cost to each item. So let's look at an example. In this case, we bought 1,000, and then we bought another 2 and 3, and then we sold another 25 and 2,200 at different times. Now, since we're using specific identification, we must know exactly when we sold each item and the cost associated with it. So here we go. But before I do anything, I always start by determining the total cost of goods available for sale. Because what you're going to do is you're going to take that cost and break it down between the units that were sold and the units that remain in ending inventory. We also know that we sold a total of 4,700 units. So now what we're going to do is take that cost of 117,000 and break it down between units sold and ending inventory. And I would always do this regardless of what method you're using, because you always want to have a test figure. And you always want to make sure that the cost you assign to units sold, or cost of goods sold, and ending inventory equals your total cost of goods available for sale. So here we go, and we're going to walk through this example. First thing we did is we sold 700 at $12, and we have 300 left. Then we sold 1,800 at $18, and now we have 200 left. And then we sold 100 at 12, and now we have 200 of those left. And then we sold 100 at 18, and now we have 100 of those left. And then we sold 2,000 of 23, and we have 1,000 left. So we have 1,300 units left, which is exactly what we should have, because we sold 4,700, which gives us our total of 6,000 units. So we've now got our total cost of goods available for sale. We can come up with our ending inventory, which is 200 times 12, 100 times 18, and 1,000 times 23. I would always do this, even though another way you could do it would be to take the 89.8 and subtract it from the 117. You always want to have ways of checking your number when you're doing accounting. And so ending inventory is going to be 27.2, which is what I got when I did the calculated based on the ending units. So our gross profit would be 57.8. Now we have 3 different cost flow methods, which has to do with how the costs run through inventory, not the units. The first is called first in, first out, FIFO. It assumes units first acquired are sold first. Ending inventory consists of the most recent acquired units. Lifo, last in, first out, assumes units last acquired are sold first. Ending inventory consists of first acquired units. Just want you to know, under the international standard, you can't use LIFO. And then the last one we have is average cost, assumes inventory cost is a mix of all goods. So we come up with a weighted average per unit. So now we're first going to look at periodic in this part. And periodic assumes that you're not going to do anything till the end of the month. So it doesn't matter when things are sold. So here, first thing we're going to do is go through and determine our ending inventory. So again, we have 117,000, 6,000 units were available. We sold 4,700, which means we have to account for 47 for cost of goods sold and 1,300 for ending inventory. And again, that has to equal that 117. So now let's go through FIFO. Now, first in, first out, periodic. What we're going to do is we know that we have the assumption is the first units that we bought were the first out the door, and we sold 4,700 units. So that means that all of these would be gone. It also means that the 2,000 would be gone. And the only thing we would have left is 1,300 of the most recently priced items. And that's how we get cost of goods sold. And the difference, units in any inventory, is going to be 1,300 times 23. And you add those together and you get your 117. And our gross profit is 60,500. Now let's take a look at Lifo. Oh, instead, let's first look at the way you do it in your problem. Again, when you're doing it in your homework, they make you do this schedule. I don't know who came up with it. But here you go. Remember, ending inventory plus cost of goods sold must equal the total cost of goods available for sale. So that's exactly the same problem, but done in their format. Now let's take a look at LIFO. The last in is the first out, which means that we're going to start with that 3,000 units at 23. And then we're going to go to 1,700 units at 18. And that gives us our total cost of goods sold, and our ending inventory is going to be made up of 1,000 units at 12 and 300 at 18. We add those together and we get our 117,000. So in this example, our gross profit is going to be 48,000. And again, when we look at our example, they total 117. Now the last one we're going to cover is weighted average. You'll always take your total cost of goods available for sale divided by the total units available for sale. So in this case, we have an average cost of $19.50. So ending inventory is going to be 1,300 units times $19.50. And cost of goods sold is going to be 4,700 units times $19.50. And that gives our total cost of goods of 117. Now, this seems like the easiest method to use, but it's not easy under perpetual because you have to average it every single time you make a sale, which is fine when you're doing it in the computer, but not so fine when you're trying to do it yourself manually. Now that gives us a gross profit of $55,950. So now let's compare our three methods. So when we do it with FIFO, we get the highest profit, and with LIFO, we get the lowest profit, and we get weighted average. It always falls between. Now, this is one of the reasons that companies like to use FIFO for tax purposes. No, LIFO for tax purposes, and for financial statement purposes, they like to use FIFO. But what the IRS asks them to do is they have to set up reserve for the difference. So also, if prices are rising, FIFO will give the highest gross profit and LIFO the lowest. Weighted average is always in the middle. And that ends this presentation.